We have with us today the team of TIW Capital Group, led by the Managing Partner and Chief Investment Officer, Mr. Mohit Ralhan. Mohit has a professional career spanning across 2 decades, 6 funds, and multiple businesses. He specializes particularly in buyouts, margin expansion, and turnaround situations. Mohit has received, amongst other accolades, the prestigious Most Promising Business Leaders of Asia Award for the years 2019 and 2020 from the Economic Times. Mohit and his team are currently managing over $1 billion. This includes a $275 million discretionary portfolio. The TIW Capital Group is based out of 10 countries, including work-in-progress countries. These are Singapore, Indonesia, Malaysia, Mongolia, India, Bahrain, Dubai, Oman, UK, and Mauritius. We would like to now welcome Mr. Mohit on stage and share with us some of his wealth of knowledge and experience as we eagerly await this worldwide launch of a unique and interesting investment risk board service. This is not a product, this is a service. So I'd like to welcome Mr. Mohit to come and explain this to us. Thank you.
Good evening, all of you. No harm wishing twice. So I'm glad to be here today. Thanks for making it. Today's agenda is a little different than historically some of you have heard me. In the past, we have spoken about, in the last 7 years, about buyout funds. I've spoken about fixed return formats. In 2021, if you recollect, we spoke about interest rates going up. I do remember in 2018, 19 beginning, we discussing about bond market, bull market about to end. Nobody believed. In 2021 June, when we launched our fixed return fund, we spoke about yields heading towards, in the western part of the world, around 4.5%, when it was, I guess, 0. Nobody heard us. And what happened in 2022, everyone knows. So what happened in 2022? Let me explain with few very simple examples. In 2022, bonds and stock fell. Bond market and stock market fell. You know that, right? What's the big deal about it? The big deal about it is that the last time bonds and stocks fell in the same year was in 1969. How many of you were working in 1969? Please raise your hand. Wow. Mr. Satyamurthy, you didn't raise your hand. Well, how many of you? Before 1969, this serious stuff, before 1969, it happened in 1931. How many of you were born in 1931? I'm not going to say that to you. I agree. You are my father's age, you know that, so I won't say that. 1872, precisely 150 years back, bonds and stocks or equivalent products fell more than what they fell in 2022. Is it audible? Because it's somber. After 1872, after 150 years, it fell again with this kind of virulence. Is it coincidental that post 1969, when bonds and stocks fell, there was 2 years, 2 years, 5 years, 7 years, 10 years, 10 years of stagflation? You remember 1970s, the lost decade? 1931, post 1931, for next 5 to 6 years, there was stagflation. We call it Great Depression. 2020, when COVID happened, markets fell quite badly in H1. But by 2022, we saw the biggest bull markets of all time because of vaccine. What does it tell you? Stock markets, bond markets are always ahead of times. So, are we staring at 5 to 6 years of stagflation from here on? TIW Capital Group believes that's what's going to happen. We are going to have 5 to 6 years of stagflation. Now, why is this important? Because during stagflationary years, two kind of profiles, income profiles lose a lot: super rich and super poor. So, let us start with why super rich tend to lose a lot. It is very simple. The super rich is always lagging. Lagging, I mean, they are late. Late to sell when markets are falling, and late to buy when markets are going up. December 2022, everyone gave a sell call, and June 2023, everyone is giving a buy call. How many of you bought in December 2022 rather than now, and how many of you sold in June 2022 rather than December 2022? Now, what happens is, once bitten, twice shy. So, let us become super conservative. Nothing wrong, but then when you become super conservative, you lose context of family inflation. Family inflation. Have you heard about family inflation? How many of you have heard about family inflation? All of you are private bankers. UBS, Julius Baer, Barclays, Lloyds, used to be Credit Suisse once upon a time. This is serious stuff. Family inflation. What do you have got to do with Kenya's inflation? Your family has a different lifestyle. Maybe your kids, grandkids are going to go for further studies. Maybe you go and spend 30 days abroad twice a year for holidays. You ought to look at and calculate in good and bad times your family inflation. It's very simple. Look at your expense last year. Identify your expenses 5 years back, tentative, and the rate at which your expenses have grown over 5 years defines your family inflation. Why is there so much of hoopla around investment scoping? In my opinion, it's so simple to have investment scope for a family. If you are conservative, your goal should be family inflation plus 2%. If you are reasonably aggressive, moderate risk, your goal should be inflation, family inflation plus maybe 3.5%. And if you are super aggressive, then your goal should be family inflation plus 5%. This comes for free. But this is extremely important in stagflationary years because of the fact, once bitten, twice shy, because of the fact super rich is late in selling and late in buying, and stagflation brings turbulence. It brings turbulence. Turbulence doesn't mean bear market, turbulence means up and down. So, you will have periods of sustained stock market, bond market exuberance, and you will have periods of sustained stock markets, bond markets dismay. 2020 H1 bear market, H2 bull market, 21 bull market, 22 bull market, 23, 22 was bull or bear? All are awake. I said bull. It's a bear market. It's confusing, right? Let me repeat. H1 of 2020 was a bear market. Correct? H2 of 2020 was a bull market. 2021 was bull market. 2022 was bear market, and 2023 is till now bull market. Do I need to prove more? So, investment risk board service, what is it all about? It's not a product, it's a service. When you started your companies, whether you started, your father, your mother, your grandfather, great-grandfather, third generation, fourth generation, all of you take pride in the fact that you are third generation, fourth generation, fifth generation. When the sailboat started from some part of India in 1880, 1890, 1910, the algorithm went well and it reached Mombasa. For some of those it went wrong, it reached South Africa, and for remaining it went to Mauritius. God knows what happened to those who went beyond Mauritius. However, so when you started your companies, you created a board. Allow me in asking, why did you create a board for your organization? Not now, when the company started. Companies Act, tick box. Any doubts? When the organization started 60 years back, 80 years back, it's Companies Act. But when business starts making money, there is skin in the game, the board becomes relevant. It starts taking role of risk manager. Of course, it's the family members who do the same. However, it becomes basically more of maker checker. Don't you find it paradoxical that you have a board for your businesses, but you don't have a risk committee or a risk board for your personal wealth? Mohit, we have a family office. I call them gatekeepers, nothing wrong, but the job of a gatekeeper is to drive returns. You get a lot of products, evaluate, look at which is the best one to invest, whether the investment committee is family members, some external members, but what's the objective is to drive returns. The job of a risk board is of a firewall. A firewall is very different from a gatekeeper. Firewall protects. The ruler of Dubai was asked in a forum recently, I don't know if some of you must have heard that, where do you see your grandson's grandson's son? Where do you see your great, 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 great grandson from now? Anyone has heard this? He replied, I agree, sir. So a very witty remark, but a practical remark. He said, my grandfather's grandfather's father, my great, 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 great grandfather was on camel. Chances are my great, 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 great grandson is going to be on camel. Intergenerational wealth transfer. If that is the goal of social animal, that's humans, then wealth preservation and having a risk board in turbulent times is necessary. Why? What you see today, my struggle with technology for 60 seconds, the way we are all sitting here in a nice 5-star, well dressed, smart homes, smart phones, everything smart around us. It started because of the Renaissance of 17th century. Any idea what was the Renaissance of 17th century? Thank you, sir. Industrial Revolution. What do you think is the Renaissance of 21st century? AI, okay, it's technology, right? Technology 1.0, 2.0, 3.0, we are in 4.0. Technology is the Renaissance of 21st century. What that's doing, it's extremely important to understand, it's challenging the unipolarity on this planet. I am not saying de-dollarization. I am not saying BRICS, I am not saying rupee, I am not saying currency, I am talking about power shift. What worked in last 40 years is not going to work in the next 25 years. Because by 2045, from today roughly, where United Kingdom plus Europe plus US is 50% roughly of the world GDP, it's going to be Asia that's 50% of world GDP. I'm not here to sell Asian product. All my products are dollar and pound. But it's important to understand what's this going to do. What's the big deal about it? The big deal about it is that West has no savings culture. Do we agree? But East has a savings culture. The costliest city on the planet, any guesses? Okay, it's close by, Singapore. So I can tell you, I stay in Singapore, rents have gone up 70% YOY, 70 rents. However, Singapore is top 5 countries in the world in terms of saving rates. Can you imagine? A city which is the costliest city has among the highest saving rates in the world. Number 1 economy is United States of America. China happens to be number 2. I can't change that. Like it or not, I can't change that. Americans save just 2.3%, that's $600 billion annually. However, Chinese save 40%, that's $8 trillion annually. So what China saves in 1 year, Americans save in 13 years. Fast forward it to Asia by 2045, Asia is going to save $30 trillion annually, whereas West will save just $10 trillion. Money is power. Power to buy real estate, power to buy intellectual property. What will happen? Where is crude? Middle East, Asia. Where is manufacturing? China, Asia. Where is it moving to? Rest of Asia, Asia. Where is semiconductors? Why is the Taiwan a big deal? Semiconductors, Asia. Where is younger population? Asia. Have you seen infrastructure in Tokyo, Shanghai, Singapore, let's say Australia because that's close by, and some other cities, Korea? Broadly speaking, this is going to result in power shift and hence wars. You'll see more wars in next 20 years because when unipolarity gets challenged, the flutter of the cat, if you hold a cat in a room and whip it, you know what the cat does? Goes to the highest point and jumps on the neck, and the cat in this case is United States of America. And hence implication on financial products, because while technologies got embedded in every sector, starting with surgery which has made the maximum. If somebody asks me where has technology made the best change to human life, I'll say surgery. By any stretch of imagination, I would love to know if it's beyond surgery. Beyond that, pharma, online banking, right, broking, credit, any sector, building information management. A lot of you are in real estate. I don't know if BIM is mandatory in Kenya or not, but most part of the world, BIM, building information management, is mandatory. Have you seen technology to drive returns by asset management companies yet? Not yet. Old school Swiss banks, they haven't embraced it. What will happen? More Credit Suisse will happen. Now, to set the context, this was so important that in these turbulent environments, where hardly 4% businesses survive third generation in United States of America, I repeat, hardly 4% businesses survive third generation and 3% fourth generation in United States of America, please understand with these turbulence, the risk with stagflation, so many changes on erosion of capital is extremely high, and whether today 6 months, 12 months or 24 months, you need risk services. You need your own risk board. That's the agenda of today. I've set the context. What I'm going to do in the next 30 minutes or so, I'm going to take you through what we do, how we do, give you examples and case studies of each of them, and then we'll open the house for Q&A. To set the context, TIW Capital Group, headquartered in Singapore, 10 countries offices with working progress included. We are based in Singapore, Indonesia, Malaysia, Mongolia, India, UAE, Bahrain, Oman, Mauritius, UK. $1 billion asset under advice. and 300 million of that is discretionary. That's what basically we do as fund management. Consulting business where we work with a lot of companies and families on change management, profit margin expansion, and family office business. Family governance, one of our verticals. When the owner or patriarch family owner turns old, the biggest risk they perceive is what? Which one? Succession. In reality, if I ask one to one, they'll say family feuds. Family feuds. The biggest risk is not structures, they are available. I guess something has changed in Kenyan structures, right? 32.5%. Are you aware? Taxation for trust structures in Kenya, 32.5%. I don't know, something I heard, you should check. But the point is, it's family feuds. So we work with families to protect family feuds, that's family governance. Then we have multiple funds. Just to set the context on the fund side, Kenyan clients, East Africa, we manage $80 million of Kenyan clients and East Africa and give $8 million of dividends every year to clients. That's tax free, just to let you know, because global income in Kenya, passive income is tax free. Moving forward, I think Henil explained about the background. We are blessed today. We have Mr. Weil from London here. We have Mr. Satyamurthy. Where is Kamlesh Bhai? Okay. Kamlesh Bhai is here. And Mr. Moez Ali Bhai, who is chairman of Aga Khan Healthcare and Aga Khan University. He is also on our board. 50 people strong team across locations. Let's jump to the topic of interest. Okay. So now, what is risk? Risk is a disease. It is a disease. You can't escape it. There's nothing called risk free. If some of you thought US Treasury is risk free, it gave enough jitters the last 30 days. Then finally one fine day, a man who both Democrats and Republicans listened to, the CEO of JP Morgan, Mr. Diamond, he said, if the next 72 hours you don't solve it, we are in trouble, and it got solved. So nothing is risk free. So our job is to identify risk, assess it, treat it, and keep monitoring it. Basically, this service is about managing risk, not managing returns. I'll give you an example. So let's say you invest in $1 million in 10 different products. Just for ease, I've kept 100,000 in each, and one of that becomes zero. Must have happened in the past 15-20 years. To break even, you need the remaining 9 to deliver 11.1% dollar return. If you move forward and 2 of them lose 50%, total is still 100, huh? Please note. Right? In absolute terms, you have still lost 100,000. Do you realize that? The remaining 8 have to deliver 12.5% to break even. And I'll still continue with the same example that in 3 you lose just 33%. So you have still lost what? 100,000. Amount of money you lost in 3 occasions is the same. But now in the remaining 7 you have to deliver, because you're selecting products, right? You have to deliver. Buyers beware. I was taught by my supervisor. I have had just one boss throughout my life, and he taught me 2 words: buyers beware. The day each one of you understand these 2 words, you'll be far better. Buyers beware. People will come and sell like I do in the service. Buyers beware. So important. Point is, 33% is the same 100,000, but the remaining 7 you need to get 14.3% return to break even, becoming difficult. What will be the impact on portfolio returns over a long period of time if the mistakes of making few wrong investment is avoided or it's continued? So, let me give you a very important example. The next 2 slides, I can actually stop after that. Literally, I can stop. But then, if I stop, all of you will ask me, how on earth will you achieve that? Because I am going to tell you in the next 2 slides what are we going to do mathematically. Then the rest of the day discussion and the time between food and you is going to be explanation of how we are going to do this. As an example, a client has a portfolio of $4 million. For ease, I have taken 500,000 in all 8. The client loses just 20% in 3, very little. More often than not, you end up losing more than that. The remaining 5 delivered fairly well in dollar terms. Cumulative return is excellent, relatively speaking, 7.17 in spite of 3 bad investments. Imagine if the 3 loss-making investments could have been avoided. Let's say you don't invest in this. We reject. Look at on the right hand side, smart selection. The family through private bankers did smart selection. And TCG, the risk board service, allowed to have smart rejection. We ensured smart rejection. You will be surprised to know your return jump up from 7.17% compounded to 10.5% pre TCG fee, and post TCG fee, forget the fee, but post is 10.26. In mathematical terms, over a decade, a $10 million portfolio, by just making this small change, you would have achieved $6.5 million extra cash flow in your pocket. You can ask your nephews, nieces, sons, daughters to do the maths, answer will be the same. After I am done today with me explaining what we do, how we do rather, now it's all going to be about how we do. What we do I have explained. I can stop as I said, but how we do, I would love to know between London, sir, no it's Moiz Ali Bhai. I was searching actually. So, after I am done, I am going to ask you between or among London, Tokyo, New York, Dubai, Singapore, Hong Kong, name one financial services company that gives this service. Open challenge. New York, London, that includes all banks, sir, right? Tokyo, Hong Kong, Dubai, Singapore. Now, there are some other hubs. I am ignoring Anamas, Panamas, all those. Would love to know who does this. So, let us start. The investment risk board service is about ensuring, while you have competence to identify smart selection through your private banks, please continue private banks because we are not a private bank. Our job is to ensure you do not invest in something that is going to lose money for you, and the monkey on our back is to ensure smart rejection. That is the nutshell of this service, and hence we are the firewall, and this service is about being a firewall. Investment risk board service is about risk analytics leading to smart rejection. We treat risk. Risk is a disease. So, let us take some of these risks. I can spend 20 hours on this, but I will just take a few examples of last 18 months and tell you that performance risk or default risk is not the only reason why you lose money, because 99.999% discussion is only around that. But there are other risks which have manifested in last 18 months that led to losses and not performance risk. To start with, shilling. How can I ignore shilling when I talk currency risk? Sir, pound. Right? What has changed? Nothing changed. A gentleman who have been meeting for last few years, who didn't want to invest with us because 9 million shilling of real estate in 1981 became 500 million shilling of money started listing. Why? Because I asked him what was dollar to shilling in 1981. Anybody please? So, 13. Who said that? Ah, you know, man, that's unfair. You were closer. It's 13. So a 500 million shilling today is not 55 times return, it's 5 times return in dollar terms. And compounded return without rent is 3.83%, and if you add 1% rent, it's 4.8%. That's about it in a market where same property is being sold multiple times. Have you heard about this in Kenya? Have you heard? If you haven't, please look around. And with taxation, illiquidity and currency. Let's move forward. Leverage. Anybody who's below 55 years of age, I'm 45, anybody who's below 55 years of age in this room hasn't seen bear market in bond market. The bond market, bull market started in 1981 and it ended in 2022. Bank of America Merrill Lynch, $18 trillion of negative yielding bond has become zero. That's their data. Negative yielding bonds become zero. Do you expect negative yields in West in the next 8-10 years? 6 years maybe? Unlikely. Anyone who took leverage got margin calls. What has that got to do with performance of underlying? Third example, counterparty. I used to talk a lot about counterparties for last 2 years, nobody heard. Have you heard of FTX? FTX? Anyone? It's a crypto exchange which fell. Counterparty. You're holding Bitcoin. Has Bitcoin become zero? No. But if you're holding Bitcoin on FTX, what's the value for Bitcoin for you? Zero. Counterparty risk. Liquidity. Last example. Otherwise, I'm saying I can go on and on. I've been given strict instruction to complete in 65 minutes. How many of your banks last year were lending? I mean, they lend, but were they lending enough or they were not lending much? Oh, folks, your country, lending much or not? Not. Where were they investing? Infrastructure bonds. What makes you think Kenyan infrastructure bond is less risk than AAA rated US bond? I am talking Silicon Valley Bank. I am not talking Kenya. Silicon Valley Bank invested in AAA rated US bond. If any of you understand banking, they were having hold to maturity bonds, and because of withdrawals, it became available for sale. So illiquidity risk became insolvency. What has that got to do with performance? For God's sake, go beyond performance. I can go example after example of each and have discussion around it. This is what we do. Now, how? As a family, you invest broadly in these 5 things. You get products through private bankers, so you invest, whether it's UBS, JB, some others. You obviously invest in listed stocks. You invest in real estate. You invest in, maybe next gen, invest in early stage companies, startups. You as seniors, maybe you're buying companies or business expansion to acquisitions. And alternates include private equity, hedge funds, structured bonds like Eurobonds, crypto, and the likes. TIW Capital Group's risk board service will evaluate each of these and give you a report and assessment which is good enough for you as a family to decide whether you have to invest or not. Whether you have any private bank, please continue. You have to have private banks. Advisors, please continue. Investment committee, your call, please continue. But anything that you want to do, even beyond private banking products, given our expertise of last 2 decades of investing in 70 companies in buyout environment with 150,000 employees in all companies we have sold till date in a double-digit dollar return compounded over 20 years, given we have done 8 million square feet in real estate in the past, given we have products on the listed side, quantamental products, companies we acquired in the machine learning space, hence understanding of listed, understanding of private banking products. Remember, if we have a family in UK, in Australia, in Indonesia, Singapore, China, here we would have seen enough products, because Citibank sells the same products in every part of the world, right? Hence the capability to evaluate these. So, let us go deeper into each. I will try and keep it short and simple, but I think it is important to dimension the capability metrics, because now it is about capability. Private banking products, I am going to take examples of few products, especially the structured notes. Industry 2 trillion, structured note, what is structured note? Okay, I am going to say something for 20 seconds and then you can delete it. There are cash bonds, income notes, growth notes with protection, growth notes no protection, income notes pay fixed coupons, participation rate with underlying price appreciation. Easy to understand? You all buy it. All of you buy it. Most of you, let me correct my statement, buy it, right? Let me tell you simply what it means. Structured note is a bond with a derivative. With a derivative. It is a bond with a derivative. So, let us take two examples. These are real products. Of course, we will look at the fine print for you, we will look at your downside protection for you, we will look at event probability, we will look at the counterparty issuer evaluation, we will look at fees alignment, conflict of interest, and look at liquidity assessment and others. But I will give you two examples, very simple. These are the simplest of notes available in the market. So, this is a note where one of the MNC banks gave that if S&P 500 basically loses 8%, your loss is covered, and on the higher side your profit for the year is covered to 14%. Simple. If S&P gives -8, you lose 0, and if S&P makes +16, you make 14. In the last 5 years, this is what S&P actually gave: 19, 15, 22, -10. So, investor return is 14 in 2019, so you lost 5, 14 in 2020 you lost 1, 14 in 2021 you lost 8, and because it is -10 up to -8 is covered, so you lost only -2. Cumulative, investor made 40, market gave 46. Why did you not buy S&P ETF? You could have just bought S&P ETF, right? Second example, a client said it is a guaranteed return product where you can expect, I mean the MNC bank told the client that you can get up to 65% return over 5 years. Fine print got missed. It said that if in any year 13% is reached or breached, then in the remaining years it will just behave like a fixed deposit of 2%. So, year 1 client made 13, and for the remaining 4 years 2 plus 2 plus 2 plus 2 is how much? 8. Horror, when they saw after 5 years return is 21, which is 3.9% compounded instead of 65. That is structured note. Let us move forward. A very large MNC bank from United States of America has sold this product in Kenya, and many clients who know how much they lost. This product is an auto call note, fixed coupon. We evaluate basically, I am showing a case study of what we had given to a client, where how much the investor gains if everything goes well, we will share that. What is the risk to the profit, risk to the principal, these are two different things, please appreciate. I repeat, risk to profit, risk to principal, and alignment of the issuer. Each term is explained. I am not going into details, I am just showing you what report we give. Each term is explained, then in a simple way where even a 90 years old can understand in a simple table what will be returned date wise if all goes well, then what are the risks attached to the gains, early redemptions, which is a opportunity loss, risk to the principal, simple 3 words, yes there is, how, in what situation, and this is a flow chart. Would love to know if any private bank has given you ever a flow chart like this, which is a very simple time wise, if this happens this is what will happen, if this happens this is what will happen. Clients who saw this did not invest, clients who did not see they invest. I have clients who are in my, who have invested in my products, where 2 different clients, one who saw this and did not invest in this and saved 40%. So, 41, thank you. matters. So on $1 million, saved $410,000 in 6 months. And another client of mine who's invested in our product but did not take, let's say, the risk board service, invested in this note and lost 41% in this market. June of 2022 when this was sold. So conclusion is very simple. You ought to preserve your capital. It is a fiduciary accountability for senior generation to pass on the baton to the next generation, adjusted for inflation. I repeat, it's a fiduciary obligation of a senior generation to pass on the wealth to the next generation with adjustment to inflation. Because what 1 million can buy today most likely will require $2.5 million 20 years from now, maybe more. Sovereign bonds. Oh my God, I've had horror stories in Kenya where I've debated with some of the, how do you define, I'm struggling for a word, best of clients in terms of intellectual debate. Gentlemen I meet often on the last day of my trip, because I know last time I met it happened till 2:30 AM. We kept discussing. Very renowned person without naming. Confidentiality is important in our business. And he got many phone calls. At 2:30, 53 calls missed by son and daughter from UK, and they were about to file a police complaint. He's vanished. It happened. Old guy. And serious debates, right? Ghana bond, Egyptian bond, Nigeria bond. The only way finally I prevailed by saying, what makes you think if United Kingdom's AAA rated bond is not safe, Egyptian bond is safe? These have been sold in this market. Sri Lankan bond, haven't they been sold? Not sold? Egyptian? Okay, after my marriage I went to Egypt, brilliant place to go for holiday. Having said that, I really don't know what changed in Egypt in last 3-4 years for you to buy, apart from the fact that they created capital controls and you can't take out Egyptian pounds, right? I was nervous about your budget to see if capital control comes in, right? So you have to see what's changing for you to buy something, sovereign bond. Okay, anybody from accounting background, or I mean a lot of you serve boards who understand finance? Sir, I want to make a statement. The biggest fraud on the planet is sovereign bond. I'll explain why. You have an IFRS system for corporate bonds. You have Basel norms, FATCA, CRS, everything. Why are governments not creating an IFRS equivalent for sovereign bonds? Because the off-balance sheet items of every country are different. If you create a standard, then at least I can understand the off-balance sheet item, because Kenyan's off-balance sheet is different from India, is different from US and different. Do I need to say more? Thank you. Ignore. This is important. I really am intrigued. Why is the world not creating an IFRS equivalent for sovereign bonds? You are putting gun on every corporate shoulder, every individual shoulder on CRS, FATCA, this list, that list, grey list, white list, black list. What about your own list? Basel norms, it's hypocrisy. But we have to live with it. Let's look at sovereign bonds. We have acquired a company that has extremely solid expertise on data analytics through machine learning around bonds. Around bonds, where in our bond engine, this is technology driven. Each of these factors are obviously used. I'm not going to detail, but these are the factors. You look at it and it helps us take a decision. So what we do is, because Bloomberg has entire data, whether for companies or macroeconomic or capital markets, it helps us, our system looks at it, and our machine learning models eventually create a credit risk score, probability of default, yield, and degree of overrating or underrating. So let's say if anybody tries to sell you a bond in the next 48 to 72 hours, we will use our system and come out with the degree of overrating or underrating. If the degree of overrating is high, we'll tell you to avoid. Risk, Warren Buffett said something, risk happens from not knowing what you are doing. I repeat, risk happens from not knowing what you are doing, and risk may not even manifest. You think something is not good and it ends up making money. That's the risk that's going to happen with us. We might tell you something where you don't invest and it ends up making money, but is intergeneration wealth transfer about probabilities? It shouldn't be, because remember what I said, if you get 1% extra return in a smart selection, it won't materially make a difference, but if you can avoid 3 products which lose money, compounding happens. So I repeat, money is made through smart selection, but compounding happens through smart rejection. Money is made through smart selection, but compounding happens through smart rejection. So the only thing which our model will tell you, which is easy to understand for anybody who is not from finance background, if the degree of underrating is, degree of rating is less, it's underrated, and probability of default is less, buy it. If the probability of default is less and it's not overrated, buy it. This is what our engine will produce and tell you. This is proprietary technology, and we haven't created a fund around it. I'm getting so much pressure from everyone. If I start sharing, then all of you in board members, Moiz Ali Bhai will tell me create a product around credit funds. Well, sir, I would use it for investment risk board, and my competitor will sulk. Because what will I earn out of a product? Bond product, 1% yield. What's 1% of $2 billion? Peanuts. I mean it. I don't know why fund management industry is so margin expansion. A lot of you have heard, maybe, I've said so many times margin expansion. This is TIW's margin expansion. Right? My client is happy, I am happy, you need me, I need you. It's symbiotic. You know what's the notice period for this product? Service rather? 30 days. You can throw me out in 30 days. If you want to negotiate 7 days, we don't mind that. You're allowed to throw us out in 7 days. Sri Lankan bond, my God, one of my Kuwaiti clients, 2019, right, 2018-19, wanted to buy $10 million of Sri Lankan bonds, and I said, let's evaluate. We spoke with the treasury head of the largest bank of Sri Lanka. After that, we communicated that don't buy. He still went and did $1 million. But you know what happened. Logic, interest payment as a percentage of revenue went to 50%. 50%. How do you survive? Every year beginning in Kenya, China will debit. Will it not? You should hope your currency depreciates to 175 so that export competitiveness goes up and the economy can sustain. To give you one data point, IMF bailed out India in 1992, remember? Once ever in life. Any idea how much the Indian currency was asked to depreciate? How much India depreciated currency in 3 months? Yeah, close 60% in 3 months. You haven't seen 60 yet. IMF is pushing it. So Sri Lankan bonds, for whatever reasons, this is what we said, didn't make sense. Now this is a client's portfolio, real client's portfolio, where a very marquee UK private bank sold this, and we were surprised. Basically, forget the fine print, these bonds essentially, is there a way to expand this? Okay. So these bonds, this is a kind of report we will give. These bonds, surprisingly, Goodyear and some others, if you see, we don't want to disclose every detail right now, but this is the kind of report we give. 3 out of 5, I'm talking about one of the best private banks from UK. And this client is a Kenyan client. Just to confirm, the Kenyan client, fairly large family office, 3 out of 5 were non-investment grade. 3 out of 5 were non-investment grade, marquee private bank and large family of Kenya. We gave analysis, objective, looked at investment scope, explained default risk, gave the credit rating of different credit rating agencies, looked at it and gave analysis, and finally explained Delta Airlines is actually safe. Look at what's happening to the industry, and gave that analysis, and restructuring of portfolio was done. So this is on the bond side. Expertise, I again repeat, it's our proprietary technology, where any bond you give, if the bond has data in Bloomberg, we'll be able to give you outcome. If a bond doesn't have data on Bloomberg, don't invest. Why would you invest something which is not even there? Is that fair? But surprising people invest. Moving forward, listed portfolio. Everyone will say they understand this. So if all of you understand this, let me ask you one question and raise your hand, including for me, if you have answer for this question. You know stock falls, you have bought a stock and you have put stop loss. Depending on your risk profile, each one will have a different stop loss. Somebody will have, Moiz Ali bhai might have 5, Yatin bhai may say he'll have 7, 8, you might have 10. So it's very easy to define when you're losing money. Do we agree? Tell me, when will you sell when you're making money? 5%, 7, 10, 20, 30, any idea? The day you have this answer, you understand listed market. Very clear. I didn't raise my hand. This is so phenomenal, and people think because it's so easy, they understand it. If you have 10 stocks in your portfolio, the ones which are making money, you'll sell fast, and the ones which are not making money, you'll hold. Right? Do we agree? Tendency, right? This is called loss aversion bias. Mr. Satyamurthy, yesterday you told me, came back that this is social scientist. You added a term to me, social scientist. I had to Google what a social scientist is. Right? But loss aversion bias. Now this is extremely important. Market returns are linked to factors. Factors like macroeconomics, so GDP growth, interest rate, inflation, currency is a factor, and style. I repeat, market return, portfolio return, listed market return I mean, happens because of factors and style. That's it. Factors and style. What is style? Somebody will say I am a value fund, low risk fund, dividend payout fund, growth fund, liquidity fund, small cap fund, momentum, quality. Don't bother. No need to take a photograph also. Don't bother. The next one is the performance of returns of top 1800 stocks of the planet by market cap on these. This is a return. But what is important to see is this one. This is our framework to evaluate your listed portfolio, irrespective of which private bank or which part of the world you get this from. Basically, economy has 4 cycles: recovery, expansion, slowdown and recession. Recovery is what? GDP is rising and inflation is bottoming. Very simple. Expansion is GDP is rising, inflation is rising. Can you tell me where we are? Slowdown is GDP is slowing, inflation is rising, and recession is GDP is falling, inflation is falling. We are midway here. We are right now here. In the last 150 years, this is again important framework. In the last 150 years, it's so obvious that credit quality improves in recovery and expansion and deteriorates in slowdown and recession. And credit spreads, again, they widen during recession and narrowing is better during, expansion. So the winning style is very simple. Size and value, forget terminology, I am just explaining framework. Do well in recovery, so that's real estate, tech, blah blah blah. Expansion, momentum, quality, growth, do well. Financials, energy, etc. Slowdown, low yield, low risk, high yield. Financials, healthcare. Recession, low risk, high quality healthcare, consumer utilities. Now, depending on the market, how do you define market? It's going to be different for each one of you because your portfolio is different. Some of you will have UK exposure, somebody will have US exposure, somebody will have India exposure, somebody will have Indonesia, Germany. Each of these countries could be in a different recovery, expansion, slowdown or recession phase, right? And hence the implication on each of that is very simple, but if you understand this, it's a 2 hours job to identify what changes have to be made in the portfolio. Investors should be able to distinguish between when a portfolio manager is actually providing returns above and beyond what they would have got anyways by holding a diversified index. Investors should look at factors to drive alpha, and factors should be added and should be removed to manage risk. This is how we will evaluate, as an example, your portfolio on listed side, whether UBS gives it, Credit Suisse, Credit Agricole or many others. One of the clients from Kenya made me speak to a senior guy from Citibank from UK, and after what I saw in the portfolio, on the face I said, "Sir, you are incompetent." To the senior director of this private bank. He said, "That's harsh." I said, "No, that's factual." It is, because my job as a fiduciary is to protect my client's capital, and what you have done is sheer incompetence unless it's fraud. So I am being milder, right? I am being polite. I am assuming your integrity is intact, and in any case I said on a lighter note, you have been bailed out by Saudi Arabia in 2008. I prefer banks who haven't been bailed out yet. It's very important, it's hard-earned money. It's hard-earned money. It's not a small capital, it's like multi-generation wealth. So listed portfolio in December 21 to a client, again in this part I explained that when cost of capital, when interest rates go up, cost of capital goes up, valuations and multiples contract, move out of FANG stock. FANG stocks gave minus 29. What is F? Facebook. A, Amazon. Second A, Apple. N, Netflix. G is Google. They gave minus 29%. And some of the portfolios I have seen were 95% technology. Come on. 95% technology. So with using the factor style framework of TRW Capital Group, we can look at any portfolio of any country, and with that framework, your nephew in class 10th can also tell you. We will just tell this, these are the countries in different phases. These stocks are identified as growth value or what, and now please make it. How much is the cost of sending kids for 3 years course in UK or US? Louder, sir.
80 to 100,000.
Shall we charge that? Now this is important. Many clients of ours have sent their next gen for MDP programs. I would like to mention 2 names here. The founder of Reliance Oil and Gas, Dhirubhai Group, is on my board in India. His son is from Stern, and he did 1 year course with us on ground. And the chairman of Textile Market of Dubai, daughter from UCLA, 1 year with us. I've given you 2 big names as an example. So this is how basically I'm saying your next gen will end up learning a lot. That's, to me, occupational hazard. The kind of report you'll get, have you heard of First Advisory? Anyone? It's the largest trust company in the world. Extremely large. Their sister concern LMM has a basically portfolio system. They don't help invest, they basically look at every investment you have and will analyze whether from risk point of view, allocation strategy point of view, from your investment scope point of view, cost, what you have been charged, is it making sense or not. LMM manages $600 billion. They are Swiss based, and we have marketing partnership, in the sense a strategic alliance with them for Africa, and this is a technology again which is embedded with us. They manage, I repeat, $600 billion. Real estate, Track record. Now what is real estate? How we do it? Very simple. Real estate is nothing but macroeconomic expertise with micro location analytics. You know that government is going to start a project in a particular location, you know what's going to happen. That's micro location analytics and macroeconomic expertise. So I am going to take an example of your favorite country, United Kingdom, and explain how we do it. In real estate, we obviously look at country, different aspects like taxation, credit, is credit availability easy, mortgage basically finance, rate of that, regulatory framework, sector, are you looking at residential, commercial, retail, warehouse, data centers, city, GDP growth, economic engines like employment generation, income growth, demographics, micro market, affordability, very important point. I am going to show you something, infrastructure, living standards, yield growth and the likes. Of course, whether you are looking at diversification, whether you are looking at capital growth or are you looking at rental yield, what's your objective. Then we will look at performance, regulations, project delays. Imagine all the projects you have are in similar stage. What a great risk to take. 1.4 million, that's 1.4 million households, 75% of loans are fixed rate loans, of which 1.4 million are going to reset by December 23. The resetting is going to happen from 2.5 to roughly 6%. Have you heard of Jingle Mail? Anyone's heard of Jingle Mail? Google? Jingle Mail? Have you heard of subprime crisis in the United States in 2008? Just Google that. Jingle Mail is essentially when the interest rates went up, people couldn't afford it, they just, not email, mail, they put the house keys in an envelope and couriered it to the bank because the value was lower than the loan. Very simple, 20% is your principal, 80% is your loan, price fell by 20%, the value is 0, and now on the 80% you are giving 5%, you are losing 5% annually. That's 25% of your investment annually. I repeat, 20% you paid, 80% you took loan, price fell 20%, so your principal is 0. Now you are paying, let's say 5%. So what are you losing? 5% on your 20. So now you are losing 25% of principal annually. What will you do? Please Google, it's a big concept, Jingle Mail. Are we expecting Jingle Mail in UK? Point to ponder. However, there are micro markets. So there is right now in UK a stalemate between low affordability and supply shortage. The supply shortage is 4.3 million households. Even with the supply that's, home shortage, and even with the supply that's available or expected to be, it's far below 300,000. And then we look at micro markets, for example, North UK, I'm not saying North London or north of London, North UK is looking far better in terms of affordability and yields. Direct investing, with 2 decades of private equity VC experience of 1,000 plus evaluations and 60 plus investment, this is our framework. Let's say you want to buy a company or someone in your family want to invest in a startup, we will talk to the management, we will make a note, we will evaluate it, present it to you. If basis that you like it, a non-binding term sheet, diligence, of course we will need external parties for financial diligence and legal diligence, and then final support on shareholding agreement, decision making and investment. This is our DNA. This is our core competence. Example, Quibi. I thought we'll take one example for a client. Look at the names that invested in this. It failed. $1.75 billion raised at 10 billion valuation pre-revenue, without revenue. Why would you do that? I just don't get it. Somebody asked me in Uganda, that one of the richest man, top 2 rich families, in a forum I was invited by Uganda Business Forum. This gentleman, I'm told, spends normally 10-15 minutes and he spent 4.5 hours. He asked me views on crypto. I said, okay, let me give you a very practical answer. Whatever you can afford to lose, invest that. I'm not against crypto, I'm an electronics engineer. The issue is, how do you trust your counterparty? Who's your counterparty? Which country's counterparty? Right? That's why FTX happened, there's no counterparty. So, whatever you can afford to lose, invest. In this case, funding was extravagant, spending was extravagant, both financial commitment from founder was low, competition was extremely high, social sharing features were very poor, excessive content cost, failed. This is a kind of note we will give to families on detailed analysis, and then there are backups around that. Alternative investments. Alternatives are tangibles like precious metals and collectibles, art, intangibles like hedge funds, private equity, private credit. Challenges are complexities, legal complexities, illiquidity. Question, you own properties in Dubai, don't tell me yes or no. Question to you, have you registered your will in Dubai? If the answer is no, for God's sake in next 7 days go and do that. Because under Sharia law, your brothers, sisters, cousins, everyone will get it except for your spouse and your kids. I have properties in Dubai. The first thing I did is went and registered. If you have accounts with banks in Bahrain, get your will registered first. These are the kind of risks, and there's one client with whom I had serious debate in this market on real estate. Everything is in one city in Kenya. I said, come on, you want to not sell this, create a REIT structure and have that rental yield transferred to your family, brilliant idea, but in a single city. He said, why? I said, droughts happen, wars happen, earthquakes happen. Debate ended without a decision, heated decisions and discussions, and I do end up having heated discussions with my clients. Turkey happened. Got a call next day. He said, I'm sorry. Question, how many of you have done earthquake insurance? Please raise your hand. Great, sir. I have done for all my properties. Those of you who have not done, for God's sake, go and do that. Basics. Why are your private bankers not getting this done to you? Come on. You're all, you are among the top 1 percentile. Sorry, let me give respect, top 0.1 percentile of this country. Top 0.1 percentile of this country. These are basics. So, we will do research, people, network integrated. Where do you get this competence, Mohit? Let me give you example. Beyond our team, on a consulting practice, I'll give you 5 examples of people who are on our consulting platform. CXO of Texas Instruments, CXO of Infosys, CXO of H&M, CXO of ING, and CXO of Pepsi. I have more, but I am just giving you 5 names. This kind of expertise, evaluation becomes far easier because that's wisdom. They've seen, they've been there, done that in many countries, with many ethnicities, with many cultures, and many situations, many regulations. Hedge fund, well, I want to make a comment, markets can remain irrational longer than you can remain solvent. Markets can remain irrational longer than you can remain solvent. Invest in hedge funds, nothing wrong, you must, to the extent you can afford to lose. You should. There are hedge funds we have seen. There is a fund we have seen in UK, we are working very closely with, 50% the net return compounded in pound. They are not Indians, locals, and I'm going to make you meet them. We are working with something with them and they do pound and New Zealand dollar pair. Interesting combination. But then if we bring to market, we will say only invest what you can afford to lose, because you can make 100% in 2 years, but I am saying you can lose. Why would you go? I know of clients in this part of the world who went and put in hedge funds $2 million, which is perhaps maybe 10% of their net worth, but why would you do that? That client I would have said, maybe put 1% of your net worth, because you can afford to lose, right? So, it is important contextually to assess risk adjusted return. It is not just return, it is risk adjusted return. Case of gold, how can I end this discussion without, last 1 or 2 slides, how can I end my discussion without talking gold? Is gold a good hedge against inflation? Yes, no. Thank you, it's no. Must compliment you, sir. But you should still buy gold because that should be used as a vehicle to transfer it to next gen. You know why? Why? You will never sell it. Do you sell gold? Right? My father will slap me if I sell gold. Because during Diwali we have a festival called Diwali. Most of you are Indian origin. So it's kept. And it's kept. My grandfather, my great-grandfather, great-great-grandfather, and just keeps increasing. And you keep seeing watching value growing and do nothing about it. But it's important because that's for family safety. But gold has been not a great bet against inflation. 1980 to 2008, it was completely lost generation for gold. Lost generation for gold. And this is what happened recently. So the last 50 years of data shows a poor correlation between gold and inflation. But you should still buy to the extent you want for family security. Okay, client journey. Basically, if you sign up, we'll look at risk reward assessment of your standalone investments. We'll look at portfolio risk check for your overall portfolio, single asset class exposures, benchmarking, sensitivities. Obviously, look at portfolio management, analysis. Then we will ask you all these questionnaires to understand your investment scope, help create that. And I've already, for free, on a lighter note, I'm saying defined how you should do it, identify your inflation and add the risk, premium to it. If you want low risk, add just 2%. If you want medium risk, add 3.5%. If you want higher risk, add 5%. You don't need to do beyond that. Canadian pension, I mean in my previous funds we had California State Pension Fund, Government of UK, ADIA Abu Dhabi Investment Authority, that's Qatar Investment Authority and the likes as investors. And Canadian pension, you will not believe it. They said, Mohit, can you give me 2% compounded return? Give me a product which is 2% compounded for 100 years. Power of 2%, sir, for 100 years. Intergeneration wealth transfer is about X% compounded over 100 years. I don't want to say beyond that. Of course, then basis this, we understand your risk behavior because you may be saying something and doing something else, right? Possible. More often than not, that's what happens. And basis this, we will basically understand what should be done on your investment scope, identify the inflation, family inflation and define the returns. So the way it will work is, we will define scope, execute NDA, confidentiality. Moiz Ali Bhai asked me yesterday about confidentiality because that's extremely critical and I must compliment you, you brought it out, so today I am myself doing that because I don't know whether you'll ask me again or not, but I think it's important for this audience. Breach of confidentiality happens because of commercial interests. Any doubts? And the only thing that can protect it is morals. Is that fair? In my business of risk board, can you tell me one commercial interest for me to go and tell your data to anybody? I'm not selling anything to you. There's no distribution. I'm not corporate advisory. I'm not investment bank. I'm not a wealth management firm. I'm not going to sell your property to somebody else. I'm not a broker. None of the inducements which will make me share that data exists. On the contrary, my business killer, something which can kill my business, is breach of confidentiality. So there is no commercial interest for you to even contemplate and assess me on moral hazards. Of course, T stands for trust, I stands for integrity and W for wealth creation, that's TIW. Mr. Satyamurthy is smiling because he gave that. Sir, I have to give credit, I've learnt in life, whoever does something should get credit. And one more thing he did in our buyout funds, he made us declare quarterly results with audited financials of all private companies. We do that. Would love to know one firm which does globally. I repeat, quarterly results with audited financials of private companies. That's him, because he's raided enough companies when he was in enforcement. So basis this allotment of client ID, welcome letter, data sharing, analysis, outcome and continued evaluation. Pricing, if you take real estate as well, then $2,000 a month. If you don't take $500 a month, it's nothing. Why we keep it? So that you know you have someone whom you have to pay $500. $500 is nothing. You won't even get an accountant in this market. However, so I repeat, pricing, if you take real estate, is $2,000 per month. If you don't take it, it's $500. And on real estate for Kenya, only 4 markets we are having competence to evaluate: Kenya, UK, Dubai, India. I mean UAE, India. These are only 4 markets. I repeat, UK, UAE, of course Kenya and India. These are 4. If you want to buy in Argentina, we don't have competence. And the main thing will be whatever return you make, we get a share of that. So basically, if you get 8% compounded dollar, at the end of the year, we will get 0.2. If you get 6%, we will get 0.15. If you get 10, we get 0.25. If you get nothing, we get nothing. More often than not, even private banks charge more than that. Why will it work for us? Very simple. We have many clients and globally, and with a hub and spoke structure, a nervous system which can evaluate with 50 people, and risk board services, because similar products, many countries, similar clients, similar products, we are able to do that. It's fairly lucrative for us if you aggregate, but it's not costly for clients if you see in standalone. On that note, I'd like to end my discussion, and I'm extremely happy to take any questions, clarifications. Feel free to ask.
You mentioned about what happened in 1872, 1932, 2019, 2020, 21, 22, 23. What is going to happen by the end of 2023, 24 and 25?
Oh, tough one. Okay, corporate bonds we believe will rally in H2. 2023, 24, 25, big will become bigger and small will become smaller. Globally, the trend which is happening in Kenya, for example, the top 7 stocks contribute 65% of market cap. That trend will become even more prevalent globally. This is very important to understand. Big is becoming bigger. If you look at the top 7 stocks of S&P 500, that has contributed almost 80%, 80, 90% of the gains. So 2023, 24, 25, you will have phases of exuberance in market and bad markets. 2023 ends, H2 we believe you will see a bond rally, especially in the corporate bonds as well, because interest rates will stall. 2023, 24, 25, big will continue to become bigger. If you look at Nasdaq chart of 2023 and of 1999, it's exactly the same. Exactly the same. I can send you the chart if you want. I have your ID, I'll send it to you. It is shocking. At that time it was for .com, now it's for AI. But big will become bigger. Importantly, sell US, buy the rest. If you have to ask me, I'm not saying US will not go up relatively. FTSE till recently was at all-time high. Come on. FTSE was at all-time high till recently, right? German DAX has outperformed US index in the last 3 months, not 3, 6 months by 15%. So we have to, in our view, not de-dollarization, but non-dollar developed market currencies will do relatively better. Having said that, I again want to repeat, big becomes bigger, corporate bond rally. US relative underperformance compared to rest, and turbulence because of stagflation. Stagflation just started. And that's when we realized that this is a service which is extremely critical given our competence and serious challenges with private banking portfolios. and importantly, we are seeing two kinds of clients signing up. We have signed now, especially in the eastern part of the world. One is technology guys. Like I can confirm to you, 2 CXOs of FANG stocks are my risk board service clients. 2 CXOs of FANG stocks. And we are seeing old generation looking at this. So, two extremes.
So how many clients do you have in this?
So, 20 plus as is. But if I look at the evaluation, my sales cycle tends to be around 5-6 months. So, there are at least 50 where we are in stages of discussions.
Have you done a satisfaction survey yet?
Okay, I can tell you about one client. Is one representative or not is not important, but what the client said is extremely important. I want to change the notice period to 3 years, that you cannot leave for 3 years.
From?
30 days.
From this, sorry, survey?
The client requested to change notice period to 3 years, so that we can't give a notice. Notice period is mutual, right? If you can give me a notice of 30 days, I can give you notice of 30 days, right?
So that's an indication of how.
Right. And yesterday in one of the meetings on a lighter note, yesterday one of the clients said that I will sign up and after learning in 6 months I'll sack you. I said no problems at all. I told Yatin bhai, add in the contract that once you remove me for next 5 years, I will not sign up.
But what I'm saying is different. Out of the 20 or so clients you've done, have you done?
Sir, my clients have recommended clients, including yesterday some of the clients who came, confidentiality I can't share, they were referred by clients.
Because I'm asking you, what percentage of your clients
I haven't lost any client.
survey?
I haven't done a formal survey. I haven't lost any client. So we are in a learning curve, let me put it this way. And frankly, when the client sees value and we see that it's too much we are giving, we will sit across the table and discuss. But Mr. Weil, you said something yesterday when we were discussing late in the night, all of us. I asked a simple question, tell me the benchmark. Has your generation seen any company doing it? You have been a renowned banker in New York and London. Has the next generation seen it? My generation seen it? How do I evaluate it? There is no benchmark, sir. There isn't a benchmark. 21st century, you need to understand one thing. Majority of the countries, the succession in third or fourth or second generation is happening now. Mongolia we started. Almost every entrepreneur is first generation. 90% entrepreneurs are first generation and average age is 65 years. Now, I can say with certainty, with due respect, that majority of first generation entrepreneurs don't allow their kids to make decisions. Go back in history, folks. Majority of first generation entrepreneurs do not allow their next generation to decide. However, they are extremely polite with their next generation. So the mistake starts there. So they are over stringent with next generation, not allowing them to take decisions. Now building is a very rare skill set. Somebody build it, that's you. Now running is different than building. You didn't allow the next gen to take decisions, and next to next gen, interest is far better than the principal. I haven't seen that yet, but that's what everyone says, and we have seen on ground. So decision making becomes dubious and it leads to challenge. It's a very, very peculiar point. What I'm trying to say, this is the time globally in the next 10-15 years when succession transfer is happening, whether it is from third to fourth, whether in your case maybe mostly second to third, and few cases third to fourth, whether in Mongolia first to second, whether in India first to second. You go to Coimbatore, Kamlesh bhai, Coimbatore, everyone is average age is 65, right? Okay, sorry, blind-sighted. 65 almost, and the next generation is mostly abroad. Who's going to run it? Tier 2 and 3, tell me how many families have shifted, the next gen has shifted out of Mombasa. You have friends, I'm sure. Where are they? And that's why we thought it makes sense to launch in East Africa. But this is globally right now, the generation transfer is happening right now.